Hello and welcome to another episode of the Saxo Market Call. Almost a little bit of a special episode, in fact, but some things are as they always are, and that is that my name is Søren Otto and I will be your host today. But we have a new guest today, and I am beyond excited to welcome Philip Jagd, head of Equities from SamPension, who is going to talk a little bit together with Peter, Garnry, and myself about tech stocks, AI, and a lot of other very interesting things. But welcome both.
Thank you.
Thank you, Søren.
And as I said, we're going to talk tech and AI, and one of the reasons why we are going to do that is that you, Philip, was recently in the US to talk to some of these companies and figure out what's sort of the vibe over there. I mean, it's a big focus area, even though we're here in Denmark, but it is a big focus area, and you wanted to go and talk to some of them about how the vibe is there and what your takeaways was from that. And that's some of the things we're going to learn about today. And then we're going to do some perspectives on the AI and tech sector in general. But I think we will start, as we always do, with recent market performance and some financial news. And obviously the FOMC meeting is very relevant there. But before we start, gentlemen, I want to start us off a little bit easy. And I want to do that with a question, because since we are going to talk about the Magnificent Seven, for instance, and other tech companies today, what do you think is more likely, that they are going to make up a greater proportion of the S&P than they are today? We have this very high concentration risk in the future, or do you think that something will happen that will lower this concentration risk? Philip, let's start with you.
I love it that you think that's an easy question. And I'm also very pleased that you didn't start with a song or something, because I was a little bit afraid there.
Yeah, I don't really have a good voice for that yet.
We can try later.
Yeah.
Honestly, I think it's hard for them to become much bigger than they are. It was the entire reason for me going over there and kicking some tires, is this concentration risk in the index from the Max 7 and from the universe of tech in general. I kind of, even if I'm a top-down guy, I'm always also a little bit of a value guy. I kind of need to get my hands dirty on these tech companies. So that's why I went. But from being there and visiting, and I talked to a lot of companies, not just Max 7, but a lot of smaller ones too. I think it's a very wide opportunity set. There's a lot of super skilled companies with strong moats and strong businesses. And I would be surprised if we don't see more kind of a broadening out of what has happened the past year than just a collapse into the nothingness. So I think Max 7 will be less of the index, but maybe it's a broadening out, and that could be within the tech, smaller cap tech sphere as well.
Yeah, so tech being still a big part, but maybe the Max 7 as an entity, a lesser part.
Yeah, I think a lot of their kind of the attractiveness of them have been that they were very solid. So an environment where we're a little bit afraid of the Fed and rates and cash flows and so on, they were kind of the safe haven bet from a lot of people, and they have essentially cost cut themselves to an earnings boom of something I haven't seen ever, I think, especially when you compare to the overall economy. So in many ways you had like predictable earnings and strong balance sheets. So that was kind of the easy pick for the last year, and that would probably be a little harder, and you have to lean out for some of the potential through maybe smaller tech stocks and other companies going forward.
Peter, what do you think?
Yeah, I've been wrong before, right? Because when we peaked in equity concentration in 2021, I wrote famously that we'll never reach another peak, and of course we did. So I think maybe in probability terms, I would say there's a 30% probability that we make an even higher index concentration, and then 70% that we have peaked and will begin to, as Philip said, broaden out, because I think there is a limit to how big they can be in terms of the overall market size. So that's sort of my view, and I think it will also, my thesis is that when we peak and we begin to see less index concentration, that will be the turning point as well in this whole passive versus active equity investing to some degree, because right now, a lot of active managers have struggled because the set of alpha has really been narrowing, and that makes it very difficult, because you risk up as an active manager to go with the herd, and that increases your portfolio risk a lot. So I think there are really interesting times ahead for active managers when we get on the other side of this mountain peak.
And with that appetizer, let's move into the three main courses, and the first one being market performance and financial news. Obviously, this is a very critical week, especially from a macro point of view. We have the FOMC meeting tomorrow. We basically know that the Fed is going to cut rates. The question is whether it's 25 or 50 basis points. But Peter, since we're here, is that the only news out there, or what are the trends and what's happening in the markets?
Yeah, if we just take the market performance, right? So the US and emerging markets have actually done pretty well over the past week. They're the best performing. Europe, a little bit up. Japan, down almost 10% for the quarter. And that's obviously because the pivot from the Bank of Japan has caused the Japanese yen to strengthen quite a lot. And there's a very high beta or sensitivity, if you will, between the Japanese equity market and its currency. So that's what's unfolding there. If you look at the past week, been a big rebound week for the two technology sectors. Up almost 5%. In the bottom, you have energy with oil prices not moving anywhere, actually lower. And then, which is quite interesting, if you look at for the quarter as a whole, there are only three sectors that are down: energy, information technology, and communication services. So communication services, we always have to explain this. It's where do you find Disney, Netflix, Google, and Meta. And if you look at the quarter, and this is where it gets interesting, because there has been a small rotation from cyclical into defensive sectors ahead of the FOMC decision to start the rate cut cycle. But if you look how the market is positioning itself, you can see that real estate and utilities in the MSCI World Index up somewhere around 16-17%. But another very interest rate sensitive sector like consumer discretionary is only up 2.5%. So you see a very clear picture emerging from how institutional investors are positioning themselves. Yes, interest rate will go down, but they will not be a positive for big item consumption, which is what drives consumer discretionary. It's rather more economic weakness, and that's why you see investors, they want their duration, and you get that in utilities and real estate from low interest rates. So I think that's the simple narrative that is panning out right now.
Do you have anything to add?
No, I completely agree. We've seen this. We are making new highs on S&P 500, and it's heydays, and we should be drinking champagne and stuff like that. You poured me some semi-warm coffee instead. That's fine. But underneath the surface, it's actually led by these defensive sectors. So there's kind of this. It's fair to say that lower yields and so on is very supportive for defensive sectors for long duration, kind of fixed cash flows. But it's a little bit of a surprise to me that you don't see some of the maybe more cyclical sectors, which should also benefit, like lower oil prices release consumption power with the consumer. Low interest rate supports capex and smaller companies' cash flow. So there's a lot of kind of good stuff happening that could support the economy going forward. And honestly, I don't think Powell or the FOMC is here to change that. So it's a little bit of a puzzle that we don't see the more growth-oriented sectors performing better.
And obviously now let's move in to talk about the FOMC meeting. As I said, the announcement will be on Wednesday, so depending on when you listen to this, it will either have happened or at least we're recording Tuesday, so we're still waiting for it. But Peter, what is it this decision that's holding back what Philip is referring to, and what's your take? Do you think it's going to be 25 or 50 basis points?
Well, the market has certainly shifted in the recent days as the Fed clearly, and I think it's a known secret that Tim Rouse, the Wall Street Journal reporter, is sort of the horse whisper to the market from the Fed, and I think the Fed wanted to be the guessing game to be more open-ended. And clearly the Tim Rouse article in the Wall Street Journal moves the SOFR contracts closer to 50 basis points, but it's not fully priced in, which means, and there's a lot of different interpretations, right? So if they go 50 basis points, you could introduce the interpretation that it's because they want to get ahead of things and they are worried about the labor market. So in theory, a 50 basis point could be a positive for the equity market, but it depends on both the forward guidance, what the rate path going forward, but also if we don't get the 50 basis point fully priced in, it would be quite unusual. I think the central bank likes to be more closer to consensus. So it's really a big guessing game right now. What do they do? I think personally they go 25, but it's a very split decision inside the Fed. And I think the reason is that they were so wrong on inflation in the entire pandemic cycle that if they were so wrong back then, why would you have a high confidence that you have a good idea of where inflation is going to go structurally right now. And the big question is, and I think this is where we can really go into the nuances of debate, is this a 68 moment? And what do I mean with a 68 moment? A 68 moment is where you had a flare up in inflation in the mid-60s. The Fed very quickly hiked interest rates, got inflation under control, and then they eased too early. That was the lesson back then in 68, and inflation came roaring back in the late 60s. And the big question is how much pent-up demand, how sensitive is the housing market, the car industry, etc., to just the slightest change in the interest rates. I think that's an unknown. The labor market is the new focus point. They don't focus too much more on the inflation. They've said that themselves. There as well, I like to look at the Indeed, US Indeed. It's a weekly time series on job postings. It has been falling and falling and falling, and ever since May, it has actually stabilized at the current level. So I don't think we have right now a labor market that is spinning out of control and into a hole. It has clearly found a new equilibrium, and that new equilibrium will continue to put wages further down, but not to low levels, and probably levels that are a little bit above where we were before we went into the pandemic. That's my guess. And that's also because my long-term view is that inflation, because of all the things we've talked about so many times, Søren, all roads leads to inflation in some degree. Not very high inflation, but I think the structural inflation level will be higher than what we have seen in the previous 4 or 5 decades.
What do you think, Philip? 25 or 50?
I think it doesn't really matter, to be honest.
Good answer.
That was my next question.
but I've been saying 50 for some time, and that's a little bit at odds with everything that's going on in the Fed and their communication about being data dependent, because I completely agree that labor market is not weak enough for them to cut 50. So if they do that and we take it up as something is breaking and they know stuff we don't, then I think it would be wrong. I think when Powell switches direction, he has often just, thrown out what he said in the past, whether it's average inflation targeting or being data dependent or whatever. I think it will be more kind of a level adjustment, so a little bit going back to where is the R-star, and it's probably a lot lower than where they are now, and go back to communicate that monetary policy works with long and variable lags, so let's do this level adjustment, get on with it, and then we may pause for a while, and we may cut less next year, and yada yada. I think that would make sense, not having to cut again in the middle of the election later in the year. But honestly, I think it's a coin toss. That's also what's being priced, and I don't really think it matters. No. I mean, I think it will be happy for stocks. I think it will be good if they cut 50. We will see this front-loading and clear dovishness that Powell has always had. Half of the guys I was in the US with, they were like, oh, then they know stuff, and everything will fall apart. So maybe I'm a little bit alone with that view. Well, JP Morgan at least also calls for 50. So.
But okay, I agree. 25 or 50, I don't think it matters, but how do you see the current forward pricing of the Fed funds rate? I think it's priced right now 11 cuts by summer next year. Is that too aggressive? Question one. And two, does that forward curve reflect the market is increasingly betting on a recession, or is it just a level adjustment down to some potential soft landing scenario?
You can say if our star is close to 3, that's kind of what market is pricing, and it always goes a little bit ahead of itself, and it's really a lot ahead of itself, I think, now.
Yeah.
So we will see some moving back and forth of those cuts. We've never seen this many cuts priced before it has happened, but of course, in recessions and so on, we have seen more cuts. So if there is a 30% chance, say, of a recession within the next 12 months, that would probably be 16 or something cuts. And then there's a 70% chance if we'll end up in your scenario before, where you said that we will have a broadening or a higher concentration, which was both up, I guess, in markets.
Yeah.
So you're not in any way thinking that the markets can go down. Then they will cut less because they won't have to. We will see that these initial cuts, I mean, right now, retail sales, consumption is growing steadily around trend or a little bit higher. Income growth, real income growth is positive. So at some point, we will probably see labor demand pick up again if things are good, and then they can cut 11 times in 2 years.
Yeah, good point. Now, at least I've done my best to drum up the idea that this meeting is very important, and it seems like that's what we're doing in the financial.
And when you say this meeting, you mean this podcast?
Yes, exactly. That is very important, much more important than the FOMC meeting for sure. But if we stick to the FOMC meeting, I'm just curious. I mean, it seems to be very clear that it's going to be either 25 or 50. And then, as you say, the forward guidance is going to be something else. Is there any scenario that they will do something that will really shake markets, or are we, even though we keep discussing the 25 to 50, but isn't it just, as you say, it doesn't really matter, and then we're going to go on from there and see what transpires?
I think the best argument for 25 is that market has eased all that the Fed needs. So, there's no need to pour more fire to that. Whatever it's called. So I think, I think that would argue for 25, and then just let the markets do their work.
All right. Okay, so we're just 15 minutes in, and now let's go to today's agenda and what we were supposed to be talking about. And that was, of course, Philip, you're gracing us with your visit here, but also that you have visiting a lot of tech companies in the US over the past week and a half or so. Obviously, you went there, but could you just start by laying out why did you go there and who did you meet?
Yeah, sure. As I mentioned in the beginning, I went there to kick some tires on the entire tech sector. I think it's super complicated. There's a very long and broad value chain from the companies we know, the Magnificent Seven, that are so dominant in the market, and then all their suppliers and the users of their technology, essentially, that face consumers or corporates. And I needed a better understanding of that. I mean, I'm a top-down guy, and nothing has been less relevant than macro for the last year. It's been all about earnings and margins of these mega-cap companies. So recognizing that micro has driven markets for the last year and can do that for longer, I thought, let's do some micro stuff.
Some micro. And who did you do some micro stuff with, and who did you meet?
Yeah, I met a lot of different companies. I had Qualcomm, AMD, Nvidia, Meta, Synopsys, one of the chip software companies, really interesting, peered by Cadence, which we didn't meet. 25 companies, Datadog, Trade Desk, Salesforce. I mean, you mentioned it. We had kind of the whole value chain. I asked one of the guys we met, like, could you please have one of those AI you talk so much about draw up the whole value chain for me in this space? Because it's a little hard to... And he was like, maybe that's a really good idea. I have to work on that. Because I don't really think many people have that overview of how they're all interlinked. And they are very interlinked, which means that the system is probably very robust, especially when a lot of the companies have very strong balance sheets. But it also means that if something blows at one point, it will probably all really sour. So I think that's interesting.
Yeah, definitely. I also think that's something that we've talked about, Peter, this idea about this, a lot of ways you can invest in AI. For instance, also a European company like ASML, like there's a lot of different trajectories you can go in terms of investing in something like AI if that's what you want as an investor.
Yeah, there's ton of opportunities, and we talked about that before, Søren, that all these things that, you have the long value chain, and what happens in long value chains is that there are always choke points where you have key suppliers that have a very strong bargaining power because they're the only ones. We always talked about this, Søren, that, the one that makes the cameras on the iPhone is a Taiwanese company. Has been one of the best performing stocks in the global equity market for 15 years, and it's not known by anyone, but they have the market position where they sell to everyone: Samsung, Google phones, iPhones. It's super interesting. I want to ask you, Philip, because you mentioned Qualcomm, because we featured Qualcomm recently as one of these companies that I don't think a lot of people know Qualcomm. It's actually the 10th most valuable company in the US equity market, and they live this weird existence as a key supplier to Apple and others, and they make custom-made AI chips. I think that was an awakening for a lot of people that, are there other people? So Nvidia do the general purpose. Mm-hmm. Qualcomm does special purpose chips within AI. Did you have any? What's your assessment of Qualcomm, and what did you learn from that conversation of what they said? Maybe a super specific
I see them
question.
maybe a little bit as kind of working their way out of this dependency they used to have on Apple, and building on a turnaround that's maybe a turnaround's a little hard to say, but getting some momentum. All the companies we met were very eager to kind of get a bite of Nvidia's big juicy cake on the cloud market. But there's so many parts of this market. Is it on edge? Is it on cloud? Is it on on-prem? Data centers, whatever. Is it an edge is kind of on phone or whatever, which is what Apple launched, with now you can, in the US at least, make your own emoji. Yay, AI to the rescue. And you can have the quick experience of a button on your camera. Well, AI is really moving the needle here. So I think, and some of these companies, like Qualcomm, is priced a lot more reasonably than, for example, Nvidia is. So and AMD is another company. They're very focused on have a high market share on the CPU market, and I don't think they will allow Nvidia to sit on the GPU market for very long, uncontested. So there's a lot of attention to kind of catching up to Nvidia. And maybe that's a bit of a challenge for them with the valuation they have. But
I sense a bear story unfolding here on Nvidia.
No, not I would say we visited Nvidia, and it was a little bit like a visiting or going to NASA or something. And it was the only place where the atmosphere was really like electric and humming of optimism and self-confidence. And I was kind of expecting going there that they all would have pardon my French, kind of a boner over themselves. But they didn't really. They were very kind of diligent and focused on value creation and thinking ahead and staying in their kind of oligopolistic market situation and competitive situation and protecting that while eating into the others' markets situation. But Nvidia was definitely kind of in a league of their own. So they have a super strong momentum, and everyone is kind of chasing. It's like whoever wins Formula 8, everyone wants to beat them, and that's Nvidia is in pole position.
It's fascinating.
And I guess and I guess it's just getting more fascinating when we see with this Blackwell chip, which is something that people have enormous expectations for, but they also seem to be running into some problems. So it must be interesting to see whether they feel like this pressure from behind getting closer.
I would say I'm always a little skeptic because I think Jensen Huang is a very strong communicator, and it's kind of the same things he always say. It's a great opportunity, and we're ahead of everyone, and yada yada. But if you go back and look at their presentations 4 years ago, 10 years ago, I think it's like 10 years ago, they started working on CUDA ahead of everyone else, kind of their software and data library layer they have on top of their chip stack. They kind of just got it right. They really got it right.
They saw a future. I think I think they have been surprised themselves.
Of course.
About the exponential growth that happened. It became
the use
so
case
binary.
of the GPU was a lot bigger than they had ever envisaged, but they saw kind of the opportunities, and then it just turned out the opportunities were bigger. And a lot of other companies had that opportunity, like Intel, who just went the completely wrong way on all their decisions, and now are struggling to revive their business and being relevant again.
But I like this. We've talked about this, Søren, that within Nvidia, that right now Nvidia is priced a little bit like Tesla was priced in 2021, with a market valuation reflecting a long-term future with a very strong market position, very high market share, very almost impossible for investors to see there could be anyone else than Nvidia. And in Tesla's case, what the market didn't see in 2021 was the massive penetration by Chinese EV makers. And that's sort of the thing that lurks in my back head here, that competition is coming for Nvidia. I saw this morning that Google apparently was announcing a new GPU architecture that looks like something out of this world compared to the Nvidia. Obviously on an experimental basis or phase, but still, I mean, the competition, because semiconductors, and I know software, as you mentioned, CUDA has been the new layer that creates moats. But the manufacturing of the chip itself is hardware. The hardware industry has never been a high margin. It is right now because of the explosive demand, but yeah.
I agree, and I think a lot of the big companies will do whatever they can not to be, put their faith in the hands of Nvidia. They really can't. So they need, from a business decision point of view, to own kind of the IP and develop their own chips. So I think a lot of the opportunity is probably more kind of in some of the suppliers into data centers, because we need to store so much data. And that's also been a kind of low margin sector for a long time, because it didn't, there was too much competition and providing RAMs and so on to the data centers. But I think that will develop, and then I think like software development or chip design is an interesting space, because they all want to kind of create their own IP chips and so on. Yeah. And then of course, if you are dependent on GPUs, you have to go to Nvidia. It works. The whole everything works. So it's critical to a business. You go with what works, even if it's a little more expensive, until someone can credibly prove that, okay, our stuff also works and can do kind of the same things. And that's not yet.
And obviously, we talk a lot about also specific companies here, but I want to stay a little bit sort of on an overall arch from your trip because tech companies is something that we talk a lot about. But what's your main takeaways from this trip? Was there anything that surprised you? Was there anything that's stuck out?
It struck me a little bit how can you put it? It seems like in this whole value chain, diverse value chain, there's a lot of market segments maybe where there's just a few players that really have a strong oligopolistic competition situation with market power in that segment. And it's really hard to eat into that because of kind of network effects that they have with existing customers and so on. And a lot of IP into the products they have. Take a company like Synopsys, and of course all the companies I mentioned, it's not a recommendation to buy them, and I'm actually really shitty at picking single stocks. But I think it's really interesting. They kind of, ARM has like the technology that a lot of the chips are built on as kind of the sandbox. And Synopsys has kind of the software that you use within the sandbox to create the wafers and design your chips. So they have like the prefab little like plastic forms that you use to build your little sandcastle in, and you can then say, oh, I want one with 3 towers, and then they have one of those that you can pay to have the one that they've designed that can do one thing and the other one can do another thing. So you kind of have to license their IPs that they have invented and combine them in the way where you really need it, and where you can optimize it to your hardware and your product and your style. And it's really hard to get around those few companies that have, 20, 30 years of experience in creating that software. So all the engineers that sit there in Silicon Valley and try to develop stuff, they're kind of using 2 or 3 different types of software to develop the next generation of chips. So we know everyone will compete to create something that compete with Nvidia, and they're all using 2 or 3 different types of software. And even if CapEx goes down and investment into data centers go down because of a recession, will you stop investing into the next chip technology? Probably not. So maybe you'll dial down a little bit, but you won't go to a halt. So I think some of those segments are really interesting.
Yeah, it's very interesting because it is, as you say, it is such a fundamental part of some of these companies' technology that they can't afford not to invest in the newest...
And maybe that's one of the other takeaways that, they're all talking AI, and they're also talking about investing ahead of the value. So they don't have a clue what they will get out of this, but they feel they have to invest in it. And they're really just looking for ways to make money on this. And they don't really have that way. So right now they're doing a lot of CapEx, gives them tax deductions and low effective tax rates. So earnings look really good. And then they will amortize the cost. So unless these investments begin to accrue some earnings, incremental earnings, you'll just see pressure on earnings growth going forward. And that's a little bit problematic, right?
Yeah. I was about to say that I mean, that sounds like a business structure that is increasing the amount of risk in these companies a fair bit.
But it's funny, right? Because we one of the analogies that we have used on this podcast is that it feels very much like the back in the railroad revolution, right? So Nvidia comes along, they invent the railroad. It can take people from A to B like 30 times faster than with horses. Everyone gets excited. So the Google, the Meta, everyone are like these railroad companies that have already some money. They're building railroad tracks and stations to every single city in the US. And then everyone's just crossing their fingers that the passengers will come. But if they don't come, then you have an overhang, as you say, Philip, right?
Railroad.
Yeah, and then we have a lot of railroad.
But I think we're early in that. I mean,
yeah, we are.
So.
Yeah, and you got to lay some tracks before you figure out how to operate them, of course.
That's how it is.
But just a final thing, Philip, before we move on to this perspective that we're already sort of talking about. Obviously, we have in the Maxim, like Nvidia, huge increases in stock prices, and you have some of the other ones that I guess haven't seen the same increases. And with the kind of uncertain macro landscape that we're moving into, did you see anything from these companies that they're trying to, like, did they work with, or what was their perception of the economy going forward? Were they just happy-go-lucky, everything is going to work out, or
no, I mean, honestly, we didn't talk much about macroeconomy. They have been running their entirely own business cycle, kind of ahead of the usual pickup. Normally, you see like a pickup in manufacturing cycle that relates with the tech cycle, but this time around, it's been kind of tech cycle leading the manufacturing cycle, and then manufacturing cycle haven't moved anywhere. So they are kind of really happy about themselves and the way that they're doing right now, and then they're razor focused on not losing the competitive edge they have to others that come in and have found a way to use AI. So they are kind of investing in this from a defensive point of view right now, and that will go on for as long as they have money. And I mean, they've been growing earnings for something like 40% the last year, so I think they have a fair amount of money to spend still.
Sure sounds like it. Philip, let's move on, unless there's anything else you want to highlight from your trip.
No, it's fine.
All right. And as it always is with scripts like this, we kind of move back and forth a little bit, but now let's at least try to move into sort of the perspective of tech and AI, and maybe also the struggles that something like Nvidia has seen in the sort of near past. Peter, the same question that I spoke with Philip about, whether he had talked to the companies about this idea of how companies are positioning themselves relative to the uncertain macro political landscape. What's your take on tech and AI in general in the realm we're in right now?
Well, as we had discussed, I mean, there is this first wave, boom wave, a lot of infrastructure investments, Nvidia being on the forefront of this wave. We've talked about before, there are some parallels. You should always be careful about extrapolating from the past, but reminds a little bit of when we built out the internet infrastructure, right? We had the Cisco, we had the Yahoo, we had all the early winners, so to speak, when the initial internet and the initial infrastructure with routers and switches was rolled out. But then the long-term winners were some very different companies that were very small at the time, right? It ended up being Alphabet or Google, Meta, also Microsoft, etc. Microsoft was big at the time, but it surely was not seen as a potential winner on the internet, and yet it became pretty big. So I think there are some similarities, because we have seen in the past, let's say 50, 60 years, that whenever you have a technology shift, also with the PC era, the early winners are not the long-term winners. So that's what I'm really curious about, is when we shake the tree and all the early winners sort of, go down again in market value, and then we get to the next phase where it's all about applications and commercialization of AI. And a lot of the valuations, some of them are stretched, some of them are not that stretched, depending on where you are in the ecosystem. So I think it's you have to do your due diligence if you invest in the technology. But I think long term, I'm actually quite excited. But I'm also very convinced that unless this time it is different, then normally the sectors that dominate an economy are not the ones that dominate in 20 years from now, right? Back in the past, it was industrial companies in the 60s, and then throughout the 70s and 80s, it was energy companies. Throughout the 90s, slowly, financials, healthcare were big. Financials became very big. Then the financial crisis hit. Then slowly underneath the surface, this technology revolution just took off. And now, we have two technology sectors that are dominating like a huge portion of the global equity market. And I know it's difficult to have that imagination, but I just have this feeling that it must be something very, very different. And my own bet is that I think 10, 15, 20 years from now, I think we'll be astonished to see how big healthcare companies will become as we solve potentially cancers. We have the whole weight epidemic, etc. There's a lot of critical problems in the world that needs to be solved. And I think actually there's far more money in solving those problems than creating a new exciting emoji or some small video without any human overlay. But that's totally a personal opinion.
What's your take, Philip? I think there's a long way to 10 or 20 years from now. Some of the companies are trying to bridge technology with real world, building strong partnerships with real world companies that sell physical products and trying to build data that they can then use to improve that whole value chain flow and advertisement possibilities and so on. Essentially helping us drive more efficient companies. I think that's really interesting, those kind of omni-channel focused data companies. We have collected a lot of data in the last 10 or 20 years, digitalizing our businesses and the world. Next phase is about structuring that data and using it to create value. And those that end up finding that needle in the haystack, they will create a lot of value. by just small adjustments to business models. So I think another takeaway I had from this was, if you think about a company that has a huge call center in India, they won't need that when you have an AI agent that can do it. And before they had to fire 10,000 employees in India or wherever they are, when they had to downsize and then go and find them again and teach them how to answer the phone. Now you just switch on an extra server in the server park, and then you have all the call staff you need. I mean, it will provide, beyond cost savings, a lot of flexibility into the cost structure of some companies. That's really interesting. So
that's actually quite interesting, right? Because with AI and potentially when it sort of merges with robotics and automation and take that to a new level, it poses a lot of danger, I think, for developing countries, right? Because the playbook for South Korea and Japan coming out of the Second World War was just to play along with the with industrialization and take the low-hanging fruit, take manufacturing that was the lowest end of the manufacturing space from the West, and that's also the playbook China did, right? But the question is whether that playbook is actually available to developing countries in the future with AI and automation, because, a factory running with only robots and AI, manufacturing whatever, sneakers, whatever it is, it probably costs almost the same in Malaysia as it cost in Romania, right? So why wouldn't you produce a lot of things closer to your consumer end markets and shipping things around the world if we can get to that point? I mean, this is just a philosophical question, but it's one of those things I often think about, that future might be a little bit difficult for these countries.
And honestly, a lot of the potential from AI is cost savings. And when you say cost savings, it's really headcount. You need fewer people to do the engineering, the programming, the whatever it is, and not just call center and low value employees. So I think it will be disruptive and hopefully positive first. And right now it's not really. Now it's just exciting. But eventually it can also provide some hardship and kind of conflict across countries and within countries. But that's kind of now I teased Peter for being 10 or 20 years. It's a long way from now, and now I'm talking. I don't know.
Yeah, and hopefully they won't be able to do podcasts at least, because then we will still have sort of a reason to be here 10 and 20 years.
There will be a robot talking instead of us. Not with our edge, of course, and good sense of humor. But
then we'll sit at our desk making emojis, and that'll also be kind of fun.
That'll also be helpful for a lot of people.
It's kind of like when you coded your own ringtones back in the day on your own mobile phones, which was also a blast. The final countdown was always a favorite.
But maybe we should ask Philip, right? Because one thing is talking, another way is what walk the talk. I mean, what's the strategic position at SamPension towards the technology sector, right? I mean,
honestly, I went there because we have a strategic value tilt.
Yeah.
It has worked for 80 years, except for the last 10 or 15. And it's a little bit annoying to have.
How long have you been there?
Just seeing the market continue to ignore it. And the confirmation I got over in the US is also from investors and people I talk to, that they go with whatever works. It also means that when it stops working, maybe some of this valuation premium will come down. I mean, the big challenge, as I see it, we've had a lot of kind of wobbles in mega caps and so on in their performance the last 2 months or so. It has all been about valuation volatility, right? Because of the companies essentially not raising expectations for the future. They have delivered on earnings and on sales, but they haven't raised their guidance. And that's what they need to do, because they're trading at such a high premium to the overall market. So I think that's what we need to see. And that's what I'm keeping my eyes razor focused on. Are these companies able in this environment to continue to beat and raise? And if not, I'll let them be for now.
Yeah, and I guess, I mean, in that regard, not a lot should happen for them for people to change their perception of them and not be so ecstatic about these companies.
No, exactly. I mean, you saw Adobe yesterday, a great company, maybe a little bit old school software company. Or not yesterday, last week, and they had a double beat, but they guided a little bit defensive on AI and the potential for that and the cost, and they got hammered.
Yeah.
So it's not enough to deliver on expectations. You have to continuously kind of feed the optimism like Jensen Huang did last week. CEO of Nvidia, I think he was behind the entire rally we saw last week, where you saw the semiconductor index up 9-ish%. On
That's
what?
crazy.
He said, we will deliver Blackwell as planned, and there's a great potential, and go.
What an analysis. Gentlemen, I've reached the end of my note paper. Do you have anything else you wanna say or do? before you talked about a song, Philip? Do you want to?
Yeah, I was thinking about which song I should ask you to sing.
Or maybe we will save that for next time, because then
we're kind of an inch from all-time high in S&P, so high into the danger zone could...
Highway to the danger zone, yeah. Then I forgot my aviators, but I'll bring them next time. No, but that's a wrap for today's episode. Then, Philip, thank you so much for joining us. Definitely hope it's the last time we do this. It's been a lot of fun. Obviously, before you go, I'm guessing if people want to hear more of your great analysis and maybe also some songs, I guess they can find you on X, formerly known as Twitter, and I think it's at Philip Jagd, right?
Probably. It's a private account, and it's mostly macro and equity stuff, but sometimes other things sneak in there. I don't think I've posted a song yet. I don't know if I can.
You can at least try, and you definitely also have to be a finance guy to say it's a private account and then talk about equities and macro stuff.
It will be they're eating the dogs, they're eating the cats.
But thank you so much for coming, Philip. And as always, also thanks to you, Peter, for your analysis. People can also find you on X if they want to hear more, and obviously also on the Saxo platforms. I think your handle is at Peter Garnry.
Sounds about right.
But on behalf of Peter, Philip, and everyone here at Saxo, thank you so much for listening. If you enjoyed today's episode, we'd very much appreciate your feedback. Also, seeing as this is the first one with an external guest, and a great one at that. Then you can always rate the Saxo Market Call wherever you listen to podcasts, or you can reach out to us at saxomarketcall@saxobank.com. Don't forget to tune in next week as we continue to explore the forces shaping the markets. Until then, stay informed and invest wisely.